Chris Jones from Sunbelt Business Advisors and True North M&A. Today, we're covering a topic that is misunderstood by both buyers and sellers. Focus on price, terms, and what you net instead of only price. At the end, I'm also going to share the big deal killer that blindsides many sellers and many buyers. Now, there is a tendency for both buyers and sellers to be hyper-focused on price, and this is completely understandable. But price is only one of the three components when it comes to negotiating the sale of your company. The other two are terms and what you net. Don't get me wrong, determining price is a critical step, and we'll cover the mechanics of valuation in future videos. But if you cannot net enough after closing costs and taxes to fund the next chapter of your life, then why would you sell? Let's talk about those terms. Along with price, you and the buyer will negotiate how and when that price will be paid. Most sellers start out saying they want all cash at closing, but the data shows that a typical transaction is 80% cash at closing and 20% paid after closing. This 20% paid after is usually in the form of seller financing, with interest being paid to the seller. Buyers like seller financing, and so do the banks. In my experience, it also helps you negotiate a better price. There are many more terms in a business sale, but this is the big one. The third factor to evaluate in your sale process is what you net. Like Ben Franklin said, nothing is certain except death and taxes. So when your exit is complete, you can be certain that a fair share will be due in taxes. If you accept all cash at closing, there's potential to be pushed into that highest tax bracket. Alternatively, if part of the purchase price is deferred, you'll be able to defer some of those taxes and reduce your taxable income. If you need all the cash from your sale on the day of closing, well, then you need it. Take the tax hit. But most sellers are going to put that money to work and only need a portion of it year one. Another factor that will impact your net is purchase price allocation or tax allocation. Without getting into the IRS code, here are the basics. Most small business sales are asset sales, not stock sales. Asset sales require the price to be allocated to different asset classes, or what I like to call buckets. Some buckets are taxed at ordinary income tax rates. Let's use 40% for this discussion. Other buckets are taxed at capital gains rates. We'll use 20% for today's discussion. So for every $1 million in purchase price, this could be the difference between $200,000 in taxes or $400,000. Here's the rub. Sellers want the lower tax bucket, but that's likely not the tax neutral bucket for the buyer. In fact, they probably want the other bucket. It helps their tax situation. So hopefully you can see how big of an issue taxes and tax allocation can become. So we've covered the importance of focusing on price, terms, and net in the exit process. Before we conclude, here's that big deal killer that I promised. Many sellers and buyers miss the issue of excluded and included assets. What exactly is included in the purchase price? What happens with cash and debt? What about accounts receivable and accounts payable? Make sure to walk through the balance sheet with your business broker and determine this. If you want to learn more about this topic or how to value your company, you can check out more of our videos here or give us a call anytime. I'll catch you in the next video.